On the morning of February 4, 2025, while most of the world was moving through an ordinary trading day, something happened in the silver market that should not have been possible. In a span of just 2 hours on the Shanghai Futures Exchange, 1.44 million April 2026 silver futures contracts changed hands. Each contract represents 15 kilograms of silver. That translates to roughly 674 million ounces traded before lunch. Across all silver contracts that day, total volume reached approximately 1.34 billion ounces. To understand how extreme that is, consider that global mine production of silver in an entire year is around 800 million ounces. Every mine in Mexico, Peru, China, Australia, every ounce pulled from the ground across 12 months, is still significantly less than what was traded in paper form in a single morning session in Shanghai. That is not volatility. That is not retail panic. That is scale that only institutions can command. At 9:30 a.m. Shanghai time, silver futures were trading near $90 per ounce. By 11:30 a.m., the price had collapsed to around $73. A 22% drop in 2 hours. Traders across Asia watched screens in disbelief. Portfolio managers in London woke up to margin calls. Risk desks in New York scrambled to understand what had broken. There was no geopolitical shock, no central bank announcement, no mine disaster, no sudden industrial demand collapse. There was only volume. Massive, coordinated, relentless volume. And yet, while paper silver was being dumped onto the exchange in historic quantities, something else was happening quietly in the physical market. 1 day earlier, on February 3, the daily vault report from the U.S. Commodity Exchange showed that approximately 3 million ounces of physical silver had been withdrawn. Not reclassified. Not shuffled between categories. Withdrawn. Around 2 million ounces moved out of Asahi Refining vaults, roughly 900,000 ounces from HSBC, and over 280,000 ounces from J.P. Morgan facilities. Total COMEX silver inventories fell toward 400 million ounces, among the lowest levels seen in years. That is not theoretical. That is physical metal, leaving institutional storage. In normal economic logic, when inventories fall and supply tightens, prices rise. Instead, the paper price was collapsing. At the same time, something even more unusual occurred in the futures market. Typically, when silver futures contracts approach expiration, only a small fraction, often between 1 and 3%, settle with physical delivery. The vast majority are rolled forward or closed out in cash. Futures are primarily instruments for price discovery and hedging, not for moving truckloads of metal. But in the first 4 days of February 2025, nearly 100% of expiring silver futures contracts were taken for physical delivery. More than 3,500 contracts, representing roughly 17.5 million ounces, were accepted and settled with actual metal. No rollovers. No cash settlement. Buyers wanted the silver itself. That is not how a comfortable, oversupplied market behaves. That is how a market behaves when physical availability matters more than price. The contradiction was stark. In Western markets, spot silver was around $75 per ounce, with futures near $76. In Shanghai, even after the crash, spot silver held closer to $86, and futures had been trading at $90 before the collapse. A $10 premium over Western pricing had existed for weeks. In globally integrated commodity markets, such persistent premiums are rare because arbitrage traders typically close the gap quickly. Yet in this case, the premium persisted. That suggests the issue was not inefficiency. It was access. Chinese industrial buyers were willing to pay more for immediate physical metal. The premium was not about speculation. It was about securing supply. To appreciate why this matters, consider the industries that depend on silver. Solar panel manufacturing requires silver for photovoltaic cells. Modern electronics use silver in circuit boards and connectors because of its unmatched conductivity. Medical devices rely on silver for antimicrobial coatings. Defense systems incorporate silver into radar, guidance electronics, and high-performance components. The rapid expansion of artificial intelligence infrastructure has triggered massive construction of data centers, each requiring significant amounts of silver for power distribution, cooling systems, and advanced computing hardware. These sectors cannot substitute paper contracts for metal. You cannot manufacture a missile guidance system with a derivative. You cannot build a solar panel with a futures agreement. You need refined, deliverable silver. In the weeks leading up to February 4th, technical analysts had been watching a resistance zone between $87 and $90. Silver had tested that ceiling multiple times and failed to break through decisively. Each rejection suggested selling pressure above 90. When the market finally broke, it did not break upward. It broke violently downward. But even as the paper market collapsed, the physical market signaled tightness. Backwardation remained present in certain spreads, meaning near-term contracts traded at higher prices than longer-dated ones. In commodity markets, backwardation often signals immediate demand exceeding available supply. At the same time, exchange for physical spreads widened, indicating that the premium required to convert paper contracts into actual metal was rising. Think about that. The paper price was falling sharply, yet the premium to obtain physical silver was increasing. That is not a normal alignment of signals. When large volumes move suddenly, markets often describe it as intent. Volume reveals intent. Moving 1.34 billion ounces of paper silver in one morning is not random activity. It requires planning, capital, and coordination. The objective appears clear: overwhelm the order book, trigger stop losses, force liquidations, and break the premium structure that had developed in China. If Chinese markets were sustaining a higher price because of strong physical demand, flooding the exchange with short positions could compress that premium and reset the narrative. In financial markets, perception often moves faster than reality. But perception cannot fabricate physical metal. While the price dropped 22%, Chinese spot pricing did not collapse proportionally. The premium narrowed but did not vanish. Physical buyers continued to take delivery. Vault withdrawals continued. Industrial users continued securing supply. This suggests that the price action may have been more about leverage and positioning than about genuine oversupply. Paper silver can be created in large quantities through futures contracts because each contract represents a promise rather than immediate ownership of metal. Physical silver, by contrast, is constrained by mining output, recycling flows, and refining capacity. Global silver mine production has been relatively flat in recent years, hovering near 800 million ounces annually. Recycling contributes additional supply, but it has not been sufficient to offset growing industrial demand. Solar installations alone have consumed increasing amounts of silver as renewable energy expansion accelerates. If industrial demand continues rising while mine output stagnates, physical inventories can tighten even if paper markets imply abundance. That divergence creates stress. Markets are designed to reconcile such stress, but the adjustment is rarely smooth. There are several possible interpretations of the February 4th event. One possibility is systematic deleveraging. If speculative long positions had built up heavily near the $90 resistance level, a coordinated sell-off could have triggered cascading margin calls, forcing further liquidation. In that scenario, the crash was primarily mechanical. Another possibility is strategic suppression, where entities with significant short exposure or industrial cost concerns benefit from lower prices and use futures markets to push prices down while quietly accumulating physical metal. A third possibility is broader monetary restructuring, where commodities increasingly serve as strategic assets in a world of high sovereign debt, currency debasement fears, and geopolitical fragmentation. China's sustained premium hints at strategic thinking. In an era where supply chains are vulnerable and economic blocs are hardening, securing critical materials becomes a matter of national strategy. Silver is not just a precious metal for jewelry or investment. It is a core input in renewable energy, electronics, medical technology, and defense. Paying a premium to ensure steady access can be rational if the alternative is production disruption. The February 4th event may have been less about price discovery and more about power demonstration. Flood the market with paper supply, crash the headline price, and test whether physical demand blinks. It did not. History shows that when paper markets diverge too far from physical fundamentals, resolution tends to favor the physical side. In the 1970s oil shocks, physical shortages overwhelmed price controls and financial assumptions. In 2008, gold's paper price volatility eventually gave way to strong physical demand and higher prices. In 2020, palladium experienced severe supply tightness that drove prices sharply upward despite broader economic uncertainty. Commodities are ultimately grounded in molecules and atoms, not in spreadsheets. For corporate treasurers and procurement officers, the implications are practical rather than philosophical. If your production line requires silver, the relevant question is not simply what the spot price is today. It is whether you can secure consistent delivery over the next quarter and at what terms. Lower headline prices may appear beneficial, but if suppliers extend lead times, raise minimum order quantities, or require advance payment, the real cost structure changes. For defense contractors, missing delivery schedules due to component shortages is not an option. For data center developers investing hundreds of millions into AI infrastructure, delays in material supply can derail entire projects. The February 4th crash may therefore represent more than a sharp move on a chart. It may signal a structural tension between leveraged financial markets and tightening physical supply chains. Paper silver is flexible, scalable, and capable of absorbing massive speculative flows. Physical silver is finite, subject to geological limits and industrial constraints. When 100% of expiring futures contracts settle for delivery, it indicates that participants value the tangible asset more than the financial abstraction. Whether this divergence resolves through higher prices, expanded mining investment, regulatory changes, or further volatility remains uncertain. Markets can remain distorted longer than participants expect. But the data points are clear. Over 1 billion ounces of paper silver traded in hours. Prices fell 22% in 2 hours. 3 million ounces left Western vaults just before the crash. Approximately 17.5 million ounces were taken for physical delivery within days. Chinese markets maintained a significant premium. Backwardation signaled tightness even during a price collapse. These are not random anomalies. They are signals. The silver market on February 4, 2025, displayed a rare and dramatic decoupling between paper price action and physical supply dynamics. For investors, industrial users, and policymakers, the lesson is straightforward. Do not assume that price alone reflects reality. In commodity markets, especially those critical to modern technology and defense, availability can matter more than valuation. The warning embedded in that 2-hour collapse is not about panic. It is about structure. When perception and physical reality move in opposite directions, the reconciliation is rarely gentle. The only real question is how long the divergence can persist before the physical side asserts itself decisively. If you found this analysis useful, don't forget to like the video, subscribe to the channel for more deep, data-driven content, and turn on notifications so you don't miss what's coming next.